Most traders believe momentum is about speed. They chase breakouts, they scalp ticks, they live in the noise. But here's what Jesse Livermore discovered in 1907, and what separates the 5% who profit from the 95% who don't. Real momentum is not movement. Real momentum is confirmation. You can move fast and lose everything, or you can move deliberately and build a fortune. The difference isn't luck. It's a psychological threshold most traders never cross. Today I'm going to show you Livermore's exact framework, the one he used to turn $1,000 into $3 million, because it breaks every rule the amateur believes, and by the end you'll understand why waiting is sometimes the hardest trade you'll ever make. But first, a question. Have you ever entered a trade feeling certain it would move, only to watch it reverse within minutes? That certainty was the problem. Livermore learned this the painful way. So did I. And that's where this story begins. Let me be direct. The moment you believe speed equals profit, you've already lost. Not your first trade, your entire future as a trader. Here's what happens in the mind of an amateur. They're watching a chart. A stock breaks above resistance. In their gut, they feel it. The momentum is there. They can see it, so they buy. Fast, decisive, certain. Within seconds, they've placed their order. Within minutes, the price retraces. Within hours, they're down 3%. By tomorrow, they've cut the trade and sworn never to trade breakouts again. The next week, they see another breakout, and they do it again. Same speed, same certainty, same outcome. This cycle repeats, sometimes for months, sometimes for years, until they've bled enough capital to quit entirely. The professional watches the same breakout and does something radically different. They do nothing. They watch. They wait. They ask a single question: is this real? And here's the paradox that most traders never resolve. The professional's inaction is actually a position. Waiting isn't passivity. Waiting is information gathering. Waiting is a trade that says, I'm going to let this move prove itself before I commit capital. Livermore understood this distinction at a cellular level. In his early years, he was like every other trader, fast, impulsive, certain. He made money on some trades and lost it just as quickly on others. His account would surge 20% in a week, then drop 30% in the next. He was riding volatility, not momentum. And volatility is a killer. The psychological threshold I'm talking about is this: the ability to tolerate watching an opportunity pass without acting on it. Think about that for a moment. A stock is moving. The move is real. You can see it, but you don't enter. You watch it move another 5%, 10%, 15%, and you don't enter. Then finally you enter, and that's when it works. This goes against every instinct you have. Your brain is wired for speed. In nature, speed means survival. The animal that hesitates dies. The trader that hesitates leaves money on the table, or so the story goes. But here's the truth that separates the 5% from the 95%. The trader who hesitates until the move is confirmed loses less money than the trader who acts on speed alone. Livermore experienced this threshold at rock bottom. It was 1907. He'd already made a fortune and lost it. He was broke, humiliated, and working as a board boy in a bucket shop, literally writing stock prices on a chalkboard for pennies a day. The irony was brutal. He was watching prices move all day, but unable to trade them. One afternoon, he was watching Union Pacific trade. He knew the stock was entering a consolidation pattern, but he wasn't allowed to trade. He had no capital, so he simply watched. He tracked every price tick. He noted where the buyers showed up. He noted where the sellers dominated. He did this for 3 weeks. When his savings finally allowed him to trade again with $5, he applied everything he'd learned from that 3-week observation period. He knew exactly where Union Pacific would hold support. He knew exactly where it would break. He traded with surgical precision. Within weeks, that $5 had become $1,000. The threshold he'd crossed wasn't intellectual. It was psychological. He'd learned to see the difference between movement and momentum. Movement is noise. Momentum is structure. Momentum and counterintuitive. The faster you enter a trade, the less certain you should be. But amateurs do the opposite. They enter fast and act more certain. This is the confirmation paradox, and it's lethal. When you enter a breakout in the first minute, you have one confirmation, a new high. That's it, one data point. But in your mind, you've already written the narrative. You've already convinced yourself it will keep going. You've already calculated the profit. You're certain, but certainty with one confirmation is just gambling with better odds than a casino. Livermore's framework required multiple confirmations before he risked real capital. This isn't complexity for its own sake. It's a filter. It's a way of saying, I will only trade when the market has given me 3 separate pieces of evidence that this move is real. The first confirmation, the initial trend. Is the asset moving in one direction with conviction? Not just moving with intent. Is there aggressive buying, or is it just a few retail traders chasing a headline? The second confirmation, the pullback hold. After the initial move, does the price retreat and then reestablish, or does it collapse back to where it started? This is where 80% of false breakouts die. The amateurs who entered on the initial breakout watch their trade go negative, panic, and exit. The professionals who waited see the pullback hold, and only then enter. The third confirmation, volume agreement. Is the smart money moving with the price? Volume is the fingerprint of institutional order flow. A stock can move higher on retail fear of missing out, but can it move higher on institutional accumulation? That's when the move becomes real. Only when all 3 confirmations align did Livermore strike. Not before. I asked you earlier, have you ever entered a trade feeling certain it would move, only to watch it reverse within minutes? That certainty was the first red flag. Because certainty based on speed is not certainty. It's overconfidence. And overconfidence is the tax amateurs pay to the market every single day. The question you should have asked yourself was, what am I seeing right now that I won't see again in 5 minutes? If the answer is the breaking of resistance, congratulations, you're seeing Cho. At 10,000 other retail traders are also seeing. You're not ahead, you're in a crowd. The professional asks a different question. What am I not seeing yet that will become obvious later? The answer, often, is structure. They're not looking at what the price did in the last minute. They're looking at what it will do in the next hour, the next day, the next week. This is the shift in perspective that separates momentum from noise. Livermore's framework wasn't invented overnight. It was forged in failure, tested in crashes, and refined through decades of watching the tape. It's not a secret. It's not complicated. But it is counterintuitive, which is why most traders ignore it. In the chapters ahead, I'm going to walk you through the exact framework he used to identify real momentum, size correctly, wait with discipline, execute cleanly, and manage exits without emotion. But before we go further, you need to understand this. The framework only works if you accept the foundational principle that separates the 5% from the 95%. Real momentum is not movement. Real momentum is confirmation. Speed is the amateur's playground. Confirmation is the professional's sanctuary. Your next trade doesn't need to be the fastest. It needs to be the most confirmed. That single shift in mindset from speed to confirmation is where your journey toward profitability actually begins. Livermore kept meticulous records. He didn't trade feelings, he traded points on a chart. Specifically, he tracked what he called pivotal points, 3 markers that told him when a move was real and when it was a false hope. Here's the story. In 1908, Livermore had just blown up his account. He was broke, humiliated, and forced to wash dishes in a restaurant. One night, while scrubbing plates, he realized his mistake. He'd been reading price movement instead of reading structure. The next morning he started over, with $5. Within weeks he'd rebuilt to $1,000 because he applied one simple rule: never trade until you see all 3 pivotal points confirmed. This principle, that structure matters more than speed, became the bedrock of everything Livermore would accomplish over the next 30 years. Most traders never learn this distinction. They spend their entire careers chasing price action, watching candles form, and reacting to news. Livermore did something radically different. He learned to read the market like a book, where each pivotal point was a sentence in a larger narrative about where institutional money was flowing. The first pivotal point is the initial trend. Does the price have directional conviction? Not volatility, conviction. You're asking, is this asset trying to go somewhere, or is it just noise? A professional waits here. An amateur enters here. This is the critical fork in the road, where most traders lose decades of potential profit without even realizing it. When a stock begins to move, the amateur sees opportunity. Their dopamine fires. They see a green candle, maybe 2 green candles, and their brain triggers the buy signal. They enter, fast, confident, certain. But here's what they're missing. They haven't yet determined if this move has legs. They haven't asked the structural question. Is this a genuine shift in buyer interest, or is this just a brief spike in retail enthusiasm that will fade in minutes? The professional, by contrast, watches the same initial move and does something that feels counterintuitive. They wait. They observe. They're asking themselves, is the buying persistent? Are new buyers stepping in continuously, or is this just the tail end of yesterday's sellers covering? Is there institutional accumulation here or just retail momentum chasing? Livermore would often describe this as watching for conviction in the move. Not every price. Movement has conviction. A stock can spike 2% on a headline only to give it all back by noon. That's not conviction. That's noise. Conviction looks different. It looks like sustained buying pressure. It looks like the price advancing, pulling back slightly, and then advancing again on higher volume. It looks like a story being written in real time. The second pivotal point is the pullback confirmation. After the initial move, the price retraces. But does it hold support or reclaim resistance? This is where 80% of false breakouts die. Livermore would watch dozens of breakouts fail at the pullback. Those traders lost money. He didn't, because he hadn't entered yet. This is absolutely critical to understand. A pullback is not a failure of the original move. A pullback is a test. The market is asking, do the buyers still believe in this direction? Or was the initial move just a temporary spike that's now exhausting itself? When the price retraces and holds, when it doesn't fall back below the initial entry point, that's when the professional knows something real is happening. Think about this from an institutional perspective. A large fund doesn't enter a position all at once. They accumulate. They buy, the price rises, they wait for a pullback, and then they buy more aggressively. This is how smart money operates. They use pullbacks to accumulate at better prices while simultaneously shaking out the weak retail traders who bought the first impulse move and panic sold during the retracement. Livermore learned to recognize this pattern because he watched it thousands of times. He saw breakouts that failed immediately. Those were false signals. He saw breakouts that pulled back and held. Those were real. The difference between a trader who makes money and a trader who doesn't is often just this one distinction: waiting for the pullback confirmation instead of entering on the eye.
Initial breakout.
The third pivotal point is the volume surge. Price moves, but does conviction follow? Volume is the fingerprint of institutional money. Retail traders see green candles. Professionals see who's actually buying. This is where amateurs and professionals diverge most clearly. Volume is honesty. You can fake a price move for a few minutes. You can't fake volume. When a stock breaks out and volume surges simultaneously, that tells you institutional money is stepping in. That tells you this isn't just a few retail traders chasing a headline. That tells you there's real structural support behind the price action. Livermore would watch the tape, literally the physical stock ticker in his era, and he could see volume patterns before price patterns were even fully formed. When he saw volume surge into a resistance level, he knew the breakout was coming. When he saw volume dry up, he knew the move was exhausting. This is tape reading at its finest. The amateur sees a stock up 5% and gets excited. The professional sees a stock up 5% on 3 times normal volume and understands that institutional buying has just confirmed what the price was suggesting. These are two entirely different things. One is emotion, one is structure. When all three align, trend with conviction, pullback that holds, and volume that confirms, that's when Livermore struck, not before. The amateur misses this step entirely and bleeds money for years wondering why they can never catch a real move. They blame the market. They blame luck. They blame their broker. But the real reason is simple. They never learned to read the 3 pivotal points. Livermore's redemption from dishwasher to $1,000 account wasn't magic. It was methodology. He applied the 3 pivotal points to every setup he watched. He waited patiently for all 3 to align, and when they did, he traded. Not before. This this refusal to trade anything less than a full 3-point confirmation, is what separates the traders who survive market crashes from the traders who don't. The framework is simple, but it requires something most traders lack: patience. You have to sit through dozens of false setups. You have to watch prices move without you. You have to tolerate the FOMO of missing moves. But here's what happens when you develop this discipline. Your win rate increases dramatically. Your position sizing becomes more effective because you're only risking capital on high probability setups. Your psychology stays intact because you're not constantly whipsawed by entering too early. This is the foundation of real momentum trading. Not speed, not certainty based on a single data point, not the fear of missing out. Real momentum is the convergence of three structural confirmations that say, beyond reasonable doubt, that smart money is moving in a specific direction and will continue to do so. In the next chapter, we're going to talk about what happens after you identify these three pivotal points, because identifying them is only half the battle. The other half, and this is where most traders fail spectacularly, is sizing your position correctly, because perfect timing with terrible position sizing is still a path to bankruptcy, and that's a lesson Livermore learned the hardest way possible. You've now learned to spot real momentum. Congratulations, you've solved the hardest 40% of trading. The remaining 60% will destroy you if you ignore this principle. Position size determines whether you survive the next swing. This is not hyperbole. This is not theory. This is observable fact written in the account statements of thousands of traders who identified setups perfectly and still went broke. They knew where the market was going. They saw the three pivotal points align. They entered at E, exactly the right time. And then they sized their position like an amateur, and the market took everything. Livermore lost millions multiple times. Not because his momentum signals were wrong. They were often right. He lost because he sized into conviction like an amateur. He'd spot a perfect three-point setup and pyramid his entire account into it, because he knew it would work, and sometimes it did. But the times it didn't, he'd lose 60% of his capital in 3 days. This pattern haunted him for years. He would be right about direction but wrong about position sizing, and the result was catastrophic. He'd make $50,000 on a brilliant short, then lose $150,000 on the next equally brilliant setup because he'd gotten overconfident. He'd increased his position size. He'd felt so certain about the signal that he'd violated his own rules, and the market punished him mercilessly for it. The turning point came in 1915. Livermore was short cotton. The signal was pristine, all three pivotal points screaming lower. The trend had conviction. The pullback had held perfectly. The volume surge had confirmed institutional selling. By every metric, this was a setup he should trade. He entered with 20% of his account. Smart, disciplined, appropriate for the signal strength. But then the move started working. The price dropped 2%, then 4%, then 6%. Greed whispered. That familiar voice in his head started talking. See? You were right. The market is doing exactly what you predicted. You should have sized bigger. You're leaving money on the table. He pyramided another 20% into the position. The price dropped another 3%. His profit was now substantial. Again the voice whispered. He pyramided another 20%. By now he had 60% of his account in one position, all short cotton, all betting on continued downside. And then the whipsaw came. Unexpected news. A report that suggested cotton supply W as tighter than expected. Institutional short covering began. Buying pressure surged. The very same institutional money that had been selling was now forced to cover. Livermore's 60% short position was right in their path. He lost $200,000 in a single day. In modern dollars, that's nearly $6 million. His account was decimated. His confidence was shattered. And worse, his psychology was broken. He'd watched his conviction be right and his account be wrong simultaneously. The disconnect between being correct about direction and being destroyed by position sizing created a psychological wound that took him months to heal. That night, sitting alone in his office, he wrote in his journal words that would define the rest of his career. The size of the position is the size of the ego, and ego is the graveyard of traders. This single sentence, written in the aftermath of a catastrophic loss, became the foundation for everything he would accomplish afterward. He realized something profound that evening. His problem was never his analysis. His problem was never his timing. His problem was that he confused being right about direction with being safe in position size. These are two entirely different things. You can be right about where the market is going and still bankrupt yourself if you size incorrectly. In fact, being right about direction almost encourages larger sizing, which is precisely when traders get destroyed. The amateur believes that if you're right about direction, you should size big. Logic suggests this. If you know where the price is going, maximize the position. But this is inverted thinking. The professional understands that the more certain you are, the less you should size, because certainty is often an illusion. The market has a way of humbling certainty, and when it does, only proper position sizing keeps you alive. Here's the professional's rule. Risk no. More than 2% of your account per trade. Not 5%, not 10%, 2%. That means if your account is $50,000, you risk $1,000. 1,000, period. This isn't a suggestion. This isn't a guideline. This is a law of survival in markets. An amateur hears this and thinks it's too small. How will I get rich, they ask. If I only risk $1,000 per trade, it will take me forever to build real money. This is the thinking that destroys accounts. It's the thinking that Livermore had before the cotton disaster. It's the thinking that kills traders. But here's the mathematics. 2% risk with a 2-1 reward ratio compounds your account 30% per year. Risk adjusted. Let me repeat that because most traders skip past this without understanding its power. 2% risk. 2-to-1 reward ratio. 55% win rate. This compounds a $50,000 account to $500,000 in approximately 4 years. That's millionaire math. That's life-changing money. Not through massive leverage, not through outsized position sizing, but through disciplined, compounding growth. What kills you is the 15% position that goes the wrong way once and turns your $50,000 into $42,500. You've just lost momentum on your own psychology. You've just given the market permission to destroy you, because once you've taken a 15% hit, you're no longer thinking clearly. You're thinking emotionally. You're thinking about revenge. You're thinking about getting the money back. And revenge trading is how small losses become account annihilation. Livermore understood this intimately because he lived it. After the cotton disaster, he implemented the 2% rule religiously, not because it felt good, not because it felt aggressive enough, but because it was the only rule that kept him alive long enough to be right about direction multiple times in a row. And that compounding effect, being right multiple times over years, while proper PO. Position sizing keeps you solvent is how fortunes are built. The amateur looks at a trader with a 2% position and thinks they're playing small. The professional looks at a trader with a 2% position and sees someone who will still be trading in 10 years. Because trading is a marathon, not a sprint. The traders who blow up are almost always the ones who tried to sprint. They sized too big too early. They risked capital they couldn't afford to lose. They let ego override discipline. Livermore's final rule, written before his death, crystallizes this entire philosophy. The tape doesn't care about your conviction. Position size is the only thing separating survivors from statistics. This is the bridge between knowing and surviving. Knowing where the market is going is perhaps 40% of the battle. Surviving long enough to profit from that knowledge is the other 60%. Position size is the insurance policy that lets you play the long game. It's the discipline that keeps you from pyramiding into conviction. It's the guardrail that prevents ego from writing checks your account can't cash. And it's the compound interest mechanism that turns small, consistent wins into generational wealth. The next chapter is about patience, about what happens after you've identified the signal and size correctly. But before we go there, you need to understand this foundation, because perfect timing with perfect sizing creates the conditions for profitability. But perfect timing with terrible sizing creates the conditions for ruin. And Livermore learned that distinction the hardest way possible. You've learned to spot momentum. You've learned to size correctly. Now comes the hardest skill, doing nothing. This sounds simple when you read it. It sounds obvious. But when you're actually trading, when you're watching a market move, when you're seeing opportunities unfold in real time, doing nothing comes one of the most psychologically difficult things a human being can do. Your brain is screaming at you to act. Your dopamine system is firing. Your fear of missing out is overwhelming. And yet, the difference between a profitable trader and a broke one is often measured in their ability to do absolutely nothing while watching price move without them. Livermore spent 70% of his time watching, 30% trading. He sat in bucket shops and stockbrokers' offices for hours, literally hours, waiting for the 3 pivotal points to align. His colleagues thought he was lazy. His rivals thought he was weak. He was neither. He was filtering. This distinction is critical. Inaction that comes from uncertainty is weakness. Inaction that comes from discipline is strength. Livermore's waiting was the strongest thing he did. Think about what this means in practical terms. If you're spending 70% of your time watching and only 30% trading, that means for every one trade you execute, you're watching roughly 2 to 3 setups that don't meet your criteria. You're seeing breakouts that don't have pullback confirmation. You're seeing volume spikes that don't correspond to price conviction. You're seeing noise that looks like signal. And you're rejecting it. Over and over again, most traders cannot do this. The human mind is pattern-seeking. It sees movement and assumes opportunity. It sees volatility and assumes profit potential. It sees any price action that aligns with its bias and takes it as confirmation to trade. But Livermore had trained himself to see differently. He saw price action as noise until the 3 pivotal points confirmed otherwise. This requires a completely different relationship with the market. In 1906, Livermore was tracking Union Pacific. A huge move was telegraphed by news. Every trader in New York was positioning. The volatility was insane. You could feel the GY in the bucket shops. Everyone was talking about Union Pacific. Everyone was loading up. Positions were being opened frantically. The excitement was palpable. But Livermore hadn't entered. His partners were furious. What are you waiting for? The move is happening now. You're going to miss it. There's an almost physical pain to the situation. You're watching your peers make money in real time. You're watching the asset move exactly as you predicted it would. And you're doing nothing. You're sitting there watching while everyone else is participating in the profits. His answer was precise and calm. The 3 points aren't aligned yet. I'm waiting for the pullback to confirm. His partners laughed at him. One even said, Livermore, you're going to be broke before the week is out because you're too scared to take the move when it's right in front of you. But Livermore had learned something they hadn't. He'd learned that the first move isn't the move. The move that proves itself through pullback confirmation is the move. So he waited. He watched Union Pacific advance another 2%, then another. Then he watched it pull back. And here's where the patience paid off. The pullback held perfectly at a support level. Volume surged on the pullback. Institutional buyers were stepping in. 3 days later, Union Pacific rolled over. All those early positions that had been entered on the initial breakout were now being trapped. The traders who couldn't wait were now in pain. They were holding losing positions. They were second-guessing themselves. Some were cutting losses. The emotional damage was being done in real time. But Livermore entered on the pullback confirmation with 2% risk and wrote it for 8% profit. A 4, 1 trade. His partners lost 12%. Let that sink in. Livermore waited for patience, sized correctly, and made 8%. His partners chased excitement, sized aggressively, and he lost 12%. The difference between these two outcomes is patience. Pure and simple. Here's the psychological truth that amateurs miss. Trading is 95% waiting, 5% execution. But retail culture glorifies the execution, the sick trade, the perfect timing. Nobody celebrates the trader who waited 3 weeks for the signal. It's not exciting. It's not Instagram-worthy. It's not the kind of story that gets retweeted. But it's profitable. The amateur sees trading as a series of exciting moments. They see it as action. They see it as decisiveness. They see it as being in the game. But the professional sees trading as 95% discipline and 5% opportunity. The professional spends their time doing the work that nobody sees. They spend their time filtering. They spend their time watching setups that don't work out. They spend their time saying no to trades that look good but don't meet the criteria. This is why Livermore could say with absolute confidence, I only trade when 3 things are true. The trend is clear, the pullback held, and volume agreed. Everything else is noise, and noise is the tax amateurs pay. This wasn't arrogance. This was wisdom earned through experience. He knew that trading anything less than a 3-point confirmation was essentially paying a tax to the market for the privilege of being wrong. The amateur pays this tax daily. They trade setups that are 70% confirmed. They trade on 2 of the 3 pivotal points because it looks good. They trade on instinct. And then they wonder why their win rate is terrible. They wonder why even when they're right about direction, they're underwater. The answer is simple. They're paying the tax. This is why professionals have lower trade frequency. A professional might take 4 to 6 trades per month. An amateur takes 4 to 6 trades per day and wonders why they're underwater after a year of active trading. The numbers seem backwards. If you're trading more often, shouldn't you be making more money? No, because the professional is filtering. They're waiting for the high probability setups. They're saying no to the mediocre ones. The amateur is fishing. They're casting their line constantly, hoping something will bite. And sure, sometimes something does. But most of the time, they're just wasting energy and capital on setups that never had a real chance of working. Livermore's filter was brutal because it had to be. In 1906, markets moved differently than they do today. There was less information flow. There was less retail participation. But the same principle held. Most price action is noise. Most moves fail at pullback. Most volume doesn't align with price. The 3 pivotal points align rarely. When they do, that's when you trade. When they don't, you wait. Think about the psychological burden this places on you. You're sitting through a market session, watching dozens of stocks move. You're seeing moves that align with your bias. You're seeing breakouts that look like they'll work. You're fighting the urge to enter constantly. And you're telling yourself no over and over again. No, no, no. Not this one. Not this one either. Where are the 3 points? This is harder than execution. This is harder than being right about a trade. This is the actual skill that separates traders. It's not cleverness. It's not analytical ability. It's patience. Your job now is simple but psychologically difficult. Wait. Let the 3 pivotal points align. Then, and only then, size 2% and execute. That's the Livermore method in 1 sentence. It's not complicated. It's not mysterious. It's straightforward. But it requires you to have a completely different relationship with the market than 95% of other traders have. You have to see setups that don't meet your criteria as failures, not opportunities. You have to see missed moves as successes, not regrets. You have to celebrate the trade you didn't take because it didn't meet your standard as much as you celebrate the trade you did take because it did. The amateur celebrates the move they caught. The professional celebrates the move they didn't blow up on. The professional celebrates the discipline. The professional celebrates the patience because they know that patience compounds. Discipline compounds. The right setups taken at the right time with the right size over a long enough period compounds into life-changing wealth. But what happens when you're in a trade and it moves against you? What happens when you've weighted perfectly, sized correctly, entered on all 3 pivotal points, and the market reverses anyway? That's the question that takes us to the final piece of Livermore's framework. Because waiting to enter isn't enough. You also have to know when to exit. And exit discipline is even harder than entry discipline. That's where we're going next. You've identified momentum. You've sized correctly. You've waited with patience. You've entered. And now your position is moving against you. This is where 90% of traders fail. They hold on, they pray, they average down, they lose everything. This is the moment that defines whether you're a trader or a gambler. Because at this point, all the work you've done, all the waiting, all the discipline, all the correct sizing, can be undone in an instant. If you make the wrong decision, the market is telling you something. Your position is in pain, and your brain is offering you 1,000 reasons to hold. The setup was perfect. I'll wait it out. The direction is correct. This is just a pullback. If I exit now, I lock in the loss. Maybe it comes back. I'm too smart to be wrong about this. I'm holding. These are the thoughts that destroy accounts. These are the thoughts. Turn small losses into account annihilation. And they feel completely rational when you're in the moment. They feel like wisdom. They feel like discipline. But they're actually the opposite of discipline. They're capitulation to ego. Livermore called his daily ritual reading the tape, literally watching the ticker symbols and understanding what institutional order flow was doing. For modern traders, the tape is the chart. It's the volume bars. It's the order flow. It's the market structure revealed in real time. He lived by one iron rule that became the foundation of his survival. The tape is the truth. Your opinion is a liability. This is profound because it inverts the normal way people think about trading. Most traders believe their opinion is their greatest asset. They spent time learning to read charts. They developed an edge. They have conviction about where the market is going, and they believe that conviction is what will make them money. But Livermore understood something different. He understood that conviction is what kills traders. The market doesn't care about your conviction. The market doesn't care about how much time you spend analyzing the setup. The market doesn't care that the 3 pivotal points were perfectly aligned when you entered. The only thing the market cares about is what's happening right now. And the only way to understand what's happening right now is to read the tape. In 1929, Livermore was short the market, correctly, historically. We now know that the market crashed in October. We now know that being short in 1929 was the right side. But Livermore didn't have the benefit of hindsight. He had a thesis about the market. He had conviction. He had entered carefully with proper sizing. His pivotal points were aligned. Everything was textbook. But on one particular day, in the middle of his short position, the tape started showing so. Nothing different. Institutional buyers were stepping in aggressively. Not retail buyers, not panic buyers. Smart money. The kind of buying that moves markets. Livermore watched for 10 minutes. The buying continued. The tape was telling him something his opinion didn't want to hear. He had a choice. He could hold his conviction. He could tell himself that this was just a temporary bounce. He could tell himself that the broader thesis was still intact. He could hold, or he could listen to the tape. He didn't hesitate. He closed the trade, a small loss. It was maybe 1.5% of his account. A rounding error on the profit he'd eventually make when the market actually crashed. But to his colleagues watching him trade, it looked insane. They mocked him relentlessly. You were right about the direction. Why would you exit? The market is going to crash. This is a gift. His answer was precise and calm. The tape said the order flow changed. I don't trade my opinion, I trade the tapes. The tape just told me this setup is broken. His colleagues couldn't understand this. They believed Livermore was abandoning a winning thesis because of temporary noise. But Livermore understood something they didn't. He understood that the tape, the actual order flow, the actual institutional movement, takes precedence over any thesis. 2 hours later, the market rallied another 3%. Livermore would have been stopped out anyway. His 2% risk stop loss would have triggered. But by exiting early, by reading the tape and responding to it, he'd done 2 critical things. First, he'd preserved an additional 1.5% of capital that he could deploy elsewhere. Second, and more importantly, he'd preserved his psychology. He wasn't forced out in panic. He wasn't sitting there watching his position deteriorate while he hoped for a reversal. He exited in control. He exited with agency. This is the psychological diff. Errance between traders who survive and traders who don't. Traders who survive maintain control over their exits. They don't wait for the market to take them out. They take themselves out when the structure breaks. This is the hardest discipline to maintain because it requires you to actively choose loss over the hope that the loss might reverse. Here's the rule professionals live by, and it's non-negotiable. If your pivotal point confirmation breaks, if the volume surge stops, if the pullback fails to hold, you exit immediately. Not at a specific percentage loss, not at some arbitrary price level, at the structural break. This is the line between being a trader and being a trader who goes broke. When you enter a trade, you've entered because all 3 pivotal points aligned. You identified trend conviction. You saw the pullback hold. You confirmed volume agreement. But the market is dynamic. Conditions change. What confirmed the trade yesterday might be breaking today. And the moment it breaks, the trade is no longer valid. It doesn't matter that you were right about direction. It doesn't matter that you sized correctly. If the structure that made the trade valid has broken, the trade is broken. This requires daily discipline. Every morning, before the open, you reconfirm your 3 pivotal points. Is the trend still showing conviction? Is the pullback still holding? Is the volume still confirming? If any of these have failed, you exit. Not because you think the market will crash, not because you're scared, but because the reason you entered is no longer present. An amateur hears this and immediately says, "But I might miss the move." A professional says, "If I'm wrong about the structure, the move isn't real, the tape doesn't lie, I do." This is the fundamental difference in how they see the market. The amateur believes their analysis is right, and the market will even truly prove it. The professional believes the tape is right and their analysis is secondary. This shift in perspective is what changes everything. You stop fighting the tape. You stop arguing with the market. You stop waiting for the market to validate your thesis. Instead, you read the tape moment by moment and respond to what it's telling you. Sometimes that means exiting early on a trade that's still moving in your direction. Sometimes that means staying in longer than you expected, but it always means listening to what the tape is saying. Livermore's last principle, written in his journal near the end of his life, crystallizes this entire philosophy. The trader who exits early once survives to trade again. The trader who holds just a little longer does not. This is the wisdom of someone who'd watched hundreds of traders get destroyed by one bad exit decision. The trader who exits at the first sign of structural breakdown might miss 1% of the move, but the trader who holds for 1% more might catch the 50% reversal that erases their entire account. The choice is simple when you understand it. You can be right 95% of the time and still go broke if you're wrong, 5% of the time with a massive position. Or you can be right 50% of the time and get rich if you size correctly and exit when the structure breaks. The second option is the professional's path. The hardest part of this discipline is psychological. When you're in a losing trade, your brain offers you 1,000 narratives about why you should hold. It offers you hope. It offers you the possibility that you were right, and the market just needs time to catch up. These narratives are seductive. They feel true. They feel like wisdom, but they're actually the voice of ego fighting to avoid admitting you were wrong. The tape doesn't care about these narratives. The tape is indifferent to your conviction. The tape imply reflects order flow, and order flow is truth. When the tape shows the structural breakdown of your setup, that's all the information you need. Exit, preserve capital, preserve psychology, move on to the next setup. This is why Livermore survived market crashes that destroyed his competitors. It's not because he was smarter. It's not because his initial analysis was better. It's because he understood that survival is about reading the tape and responding to what it says, not fighting it. He understood that the exit is where traders make their real money, not in being right about direction, but in being right about exits. The next chapter brings all of this together. We're going to see how Livermore integrated identification, sizing, patience, and exit discipline into a complete, repeatable system. Because that's the missing piece that most traders never figure out. They understand some of these principles, but they never integrate them into a coherent process, and without the process, even perfect principles lead to chaos. That's where the final piece of the puzzle comes in. Let me tie this together because the real power isn't in any single principle. It's in how they stack. You've now spent time learning each component of Livermore's framework individually. You understand the 3 pivotal points. You understand position sizing. You understand patience. You understand exit discipline. You understand that the tape is the truth. But understanding individual pieces is different from understanding how they integrate into a system. And it's the system, the integration of all these principles into a repeatable sequential process, that actually makes money. Most traders spend their entire careers learning fragments. They learn about moving averages. They learn about support and resistance. They learn about Fibonacci retracements. They learn about volume. They learn ABU, T divergence. They learn 1,000 individual concepts, but they never learn how to integrate them into a coherent system. So they have knowledge without wisdom. They have tools without purpose. They have understanding without results. Livermore's framework is different. It's a sequence, not a shopping list. You don't pick and choose. You don't use the parts that feel comfortable and ignore the parts that feel hard. You execute in order every single time, with the understanding that each step builds on the previous one. First, identify. Wait until all 3 pivotal points align. Trend conviction, pullback confirmation, volume surge. This kills 80% of false signals immediately. This is the foundational step. You cannot move forward without this. You cannot skip this and compensate with better sizing or better exits. The identification has to be right. The structure has to be there. Only when all 3 pivotal points are aligned do you move to the next step. This alone will change your trading. Most traders never do this. They trade on 2 points. They trade on intuition. They trade on hope. But when you force yourself to wait for all 3 points to align, something magical happens. Your win rate goes up. Not dramatically at first, but it goes up. And more importantly, Your psychology stabilizes because you're no longer trading ambiguous setups. Second, size. Risk 2% per trade. This kills ego and compounds wealth. Here's the mathematics that most traders refuse to believe. A $50,000 account with 2% risk per trade, a 2-1 reward ratio, and a 55% win rate becomes $500,000 in 4 years. Not through some miracle, not through luck, through mathematical compounding. Think about this. You start with $50,000. You risk $1,000 per trade. Your 55% win rate means you win 11 trades and lose 9 in a 20-trade month. Your winning trades average $2,000 profit. Your losing TR aids average $1,000 loss. Net profit for the month, $22,000 minus $9,000 equals $13,000. That's 26% monthly return. Over 12 months, compounded, that's approximately 30% annual return. Over 4 years, compounded, that's roughly 10 times your starting capital. This math works. The reason most traders don't experience this math is because they abandon the 2% rule. They increase position sizing when they're winning. They risk 5%, then 10%, then 15% looking for faster returns. And then one 15% loss erases months of careful compounding. They blow up their accounts and swear that the math doesn't work. But the math works perfectly. The execution doesn't. Third, wait. Let the setup mature. This is psychological hardship. Embrace it. Professionals are bored most of the time. This is the step that separates traders from amateurs more than any other. This step requires you to be completely comfortable with inaction. It requires you to watch setups that don't meet your criteria. It requires you to see price move without you. It requires you to tolerate missing moves. Most traders can't do this. They experience FOMO. They feel like they're not doing their job as a trader if they're not trading. But professionals understand that waiting is the job. They understand that 70% of their time is watching, 30% is trading. They understand that boredom is a feature of profitability, not a bug. When you truly internalize this step, your entire relationship with markets changes. You stop seeing every price move as an opportunity. You start seeing most price moves as noise. You start being selective. You start waiting for the setups that are obviously high probability instead of forcing trades into ambiguous situations. Fourth, execute. When all conditions align, pull the trigger cleanly. No hesitation, no second guessing. This is where most traders freeze. They've waited. They've done the work. The setup is there. All 3 pivotal points are aligned. And then their brain starts offering them doubt. What if I'm wrong? What if this is the one time the setup fails? What if the market reverses the second I enter? The professional has done the work. The professional knows the setup is right. So they execute. Clean, decisive, 2% risk, done, no second guessing, no hesitation. The tape has given them the signal. They respond to it. Fifth, manage. Every day reconfirm your pivotal points. If they break, exit without argument. The tape is your only boss. This is the exit discipline that keeps you alive. You enter on the 3 points, but those points can break. When they do, you exit. Not at some arbitrary stop-loss, not at some price target. At the structural break. This daily reconfirmation is critical. Every morning you're asking, is the trend still showing conviction? Is the pullback still holding? Is the volume still confirming? If the answer to any of these is no, you exit. You don't wait for the day to end. You don't wait to see what happens. You exit, preserve capital, and move on. Sixth, repeat. You don't need 10 trades per week. You don't need to be constantly active. You need 4 quality trades per month. That's enough to change your life if you follow the process. 4 trades per month. That's 1 per week. That's incredibly manageable. That's completely achievable even with a day job. But most traders want more. They want action. They want excitement. So they force trades. And then they wonder why they're underwater. Livermore used this exact sequence, identify, size, wait, execute, manage, repeat, to survive every market crash from 1906 to 1940. He used it in 1907. He used it in 1920. He used it in 1929. He used it in every market condition. It's not flashy. It's not viral. It doesn't give you the dopamine hit of a huge win. but it works, which is why the amateurs ignore it and the professionals live by it. The amateurs want something faster. They want something sexier. They want something that feels like they're beating the market. But the professionals understand that beating the market isn't the goal. Surviving the market is the goal. Making steady, compounding returns over a long enough time period is the goal. And this framework achieves that goal. Here's what's remarkable about this sequence. It's not complicated. It's not requiring advanced mathematics. It's not requiring high-frequency data. It's not requiring algorithmic analysis. It's pure mechanical discipline applied to price action and volume. A trader in 1906 could use this. A trader today can use this. A trader 50 years from now can use this because it's based on human psychology and market structure, not on trend strength or statistical models. The framework works because it forces you to wait for high probability setups. It forces you to size correctly so that even a 40% win rate is profitable. It forces you to have daily discipline so that you don't hold losers. It forces you to have a repeatable process so that you don't make emotional decisions. Each step builds on the previous one. They're not independent. They're interconnected. Your next move is simple but requires commitment. Pick one market. Apply all 6 steps. Track your results for 30 days. You'll be shocked by the clarity. Not the profits, clarity. Clarity about what high probability setups look like. Clarity about when you should trade and when you should wait. Clarity about your own psychology. Because when you track your results and see which trades work and which ones don't, you start seeing patterns. You start understanding what a real setup looks like versus what just looks like a setup. And here's the profound truth that emerges after 30 days of applying. Framework, profits follow clarity, not the other way around. You don't get rich first, and then develop clarity. You develop clarity first, and then the profits follow naturally. Clarity is the leading indicator. Profits are the lagging indicator. This is where we began. Remember the opening paradox? Real momentum is not movement. Real momentum is confirmation. After going through Livermore's complete framework, identification, sizing, patience, execution, management, and repetition, you now understand what that means. Real momentum is the convergence of structure that tells you smart money is moving in a specific direction and will continue to do so. The amateur sees price movement and trades. The professional sees structural confirmation and trades. The amateur is chasing momentum. The professional is reading the tape. The amateur is hoping. The professional is following a system. The difference in outcomes over a 5-year period isn't small. It's the difference between broke and millionaire. You now have the framework. You now have the sequence. You now have everything Livermore used to build and rebuild his fortune multiple times. The only question that remains is, will you execute it? Will you have the discipline to wait for all 3 pivotal points? Will you have the courage to size small when everyone else is sizing big? Will you have the patience to watch without trading? Will you have the agency to exit when the structure breaks? This is where the real work begins, not in learning these principles, but in applying them day after day, trade after trade, until they become instinct, until waiting feels normal, until 2% sizing feels right, until exiting on structural breaks feels like the only logical choice. That's when you cross the threshold. That's when you move from the 95% who fail to the 5% who profit. That's when the tape becomes your truth instead of your opinion becoming your liability.